What if you could read the clues hidden inside a stock's data before a total disaster strikes? Well, today we're going to be technical detectives. We're going to investigate the absolutely catastrophic collapse of a stock, SDM, to see exactly what the charts were trying to tell us all along. All right, let's get into it. So, this is the number right at the heart of our mystery, a mind-blowing 82.8% loss in value. I mean, this isn't just a bad day at the office, it is a complete and total wipeout. Our job now is to figure out how on earth did this happen and what warning signs were flashing bright red in the data.
And let me tell you, it happened fast. Just look at this timeline. In early July, the stock is just kind of hanging out around $10. Then it just skyrockets to a peak of nearly $30 by the end of the month, and then the floor just drops out. By September 26th, it hits absolute rock bottom at $1.85. The speed of that collapse is just breathtaking.
Okay, so let's officially begin our investigation. We're going to dissect this nosedive piece by piece and use the tools of technical analysis to really understand the anatomy of this total failure. The very first clue, as always, is price and volume. Now, what's really telling here is that final row. On September 26th, the day of the massive crash, the trading volume just explodes to nearly 26 million shares. That is a gigantic spike. When you see a huge price drop combined with that kind of extreme volume, it means everyone, big institutions, small investors, they are all sprinting for the exit at the exact same time. The market is screaming just one thing: panic selling. But here's the thing. Panic doesn't just come out of nowhere. To understand it, we need to see the bigger picture. And that means we need to look for the underlying trend, kind of like following the footprints the market was leaving behind long before the crash. So let's dig into our first set of clues. And our main tool for this job is the moving average. The best way to think about it is like this. Instead of getting lost in every single tiny up and down tick of the price, a moving average just smooths it all out into one single clear line. It shows us the average path the stock has been taking. Simple, right? And this slide just lays out the problem for SDM in brutal detail. On the left, you see the short-term mood is totally negative. The faster moving average is below the slower one. That's a bad sign. But then you look to the right, and the long-term story, it's even worse. The 100-day average is way up there near $11, while the actual price has just cratered to 1.85. So both the immediate and the long-term trends were screaming the same thing: bearish.
Okay, so we know the trend was down. The footprints are clear, but how fast was it falling? Was this a gentle slide, or was it a rock plummeting off a cliff? For that, we need to look at momentum indicators. They're basically a speedometer for the stock price.
So our first speedometer is the MACD. Now, you don't need to worry about the long name. The key thing to watch is the relationship between the MACD value itself and its signal line. As you can see right here, the MACD value, which is negative, is way below its signal line. This is a classic, clear, bearish signal. And it's telling us that the downward momentum wasn't just there, it was strong and actually picking up speed.
Our next indicator is the RSI, or Relative Strength Index. Honestly, the best way to think about this one is as a pressure gauge. Is the buying pressure high, or is the selling pressure high? It just gives us a simple reading from 0 to 100.
And SDM's pressure gauge was reading 28.68. Now, generally, any reading below 30 is considered oversold. And that doesn't just mean the stock is going down. It means the selling has been so relentless, so one-sided, that the selling pressure wasn't just high, it was becoming extreme.
So far in our little detective story, every single clue is pointing in the exact same direction. So now it's time to lay all the evidence out on the table and see just how overwhelming the case against this stock really was.
And this is it's incredible. Look at this case file. We've got Bollinger Bands, and the price is trading below the bottom of the band, a sign of extreme bearish pressure. We've got the Arun indicator, and it's confirming a powerful downtrend. Then we have the CCI, another momentum gauge, showing extremely strong bearish momentum. It literally does not matter which tool you pick up, every single piece of evidence is telling the exact same story.
So the verdict from all this data is unanimous. There's no ambiguity here, not at all. When you see every indicator agree this forcefully, it's often a sign of what we call market capitulation. That's the point where investors just give up. They throw in the towel and sell at any price just to get out. The stock wasn't just weak, it was fundamentally broken.
All right, the investigation of the crash itself is complete. We know what happened. But, knowing what happened is only half the battle. Now we have to use our evidence to look forward and ask the big question. What happens next? A rebound, a flatline, or an even deeper fall?
To answer that, we have to look at the key price levels. Right now, the stock is sitting at $1.85. To recover, it has to break through some major resistance hurdles. Think of them like ceilings, first at $5.18 and then all the way up at $11.51. But here's the really scary part. Because it's at an all-time low, there is absolutely no historical support level below it. There is no safety net to catch it if it falls any further.
So this really leaves us with three possible futures. First, you've got the bullish rebound, where this extreme oversold condition triggers a sharp bounce. Second, the bearish continuation, where more bad news just keeps pushing it down. Or third, neutral consolidation, where the stock just goes sideways, as everyone tries to figure out what in the world just happened.
So the final analysis really lands on this critical insight. Because the stock is so extremely oversold, a rebound seems like the most probable scenario. But, and believe me, this is a huge but, after a fall this bad, investors have to be incredibly wary. The risk of another huge drop is still just unbelievably high.
Which leaves us with the ultimate question for anyone watching a stock like this. All the technical data points towards a bounce, but after a crash this severe, you have to ask yourself, is it the start of a genuine recovery, or is it what traders call a dead cat bounce, a temporary fake rise right before an even deeper fall? That right there is the billion-dollar question the market still has to answer.